Mode.
Good evening, everyone. Welcome to Admiral Markets webinar, Price Action Trading 3. So today we are gonna have some look at a new pattern system presentation, and this one will be different from others because this is the one which I've been teaching some time ago, and I stopped doing that when I made the Camarilla MACD. So this is a part of that teaching which I did some time ago, and this is the first part of Price Action Trading 3. So this is the final part of Price Action, and we will have one or two additional webinars to Price Action Trading, but only which are connected. Those will be connected to this presentation today, because this is a good strategy which has its roots in price action, and it really it was a strong one. But now, as you already know, I trade Camarilla MACD, and it's stronger in its sense. But this one, you can also make money with that. The only thing is you cannot trade counter trade with it. This is primarily price action trading, trend trading, and it can be exploited. Breakouts can be exploited to some extent, but primarily this is a trend trading system and trend trading method, I can say. So I will show you the basics today, and next time we will talk a little bit. We will talk about it just a bit more, because I will present you how to trade breakouts with it, and also how to trade divergence with it. For some of you who know me from Euro-Dollar trade some 3-4 years ago on Forex Factory, this is basically from this system I use, and this strategy I use signals which are generated on Forex Factory website and later on Euro-Dollar trade. So basically this strategy was having its golden days during Euro-Dollar sell-off some time ago. You remember that night in the year of 2009, 2008 particularly, and it was very, very good because that was a very strong trend, indeed a great trend, and this method works perfectly in big trends. Today, as you can see, not just today, last couple of years, especially this last year, has been very, I cannot say trend friendly. Basically, we didn't have very, very big trends except for some yen pairs and other stuff. And you know that I moved from trading 4 currency pairs to trading 23, 24 currency pairs. So from Euro, Dollar, Australian Dollar, Cable, and Dollar, Swiss, Dollar, Yen, I moved to trade 23, 24 pairs. So you can read about it in my analysis each day on Admiral Markets blog and Forex Factory Spiders Den. So first of all, before we start with presentation, we need to describe and to cite some risk disclaimers. Online educational materials are developed by Admiral Markets AS Estonia for a global audience. Therefore, please take into consideration that the information in this session may not be suitable for everyone. To get a corresponding information on charting conditions and any other detail, please visit www.admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Then, risk disclosure statement, which describes all the risks associated with Forex market. By proceeding further, you're accepting all the risks associated with Forex market. You can take a pause to read it. And by saying that, we need the final risk disclaimer. Admiral Markets UK Ltd takes no responsibility for the information accuracy. The analysis represents the personal opinion of the author, me, and in no way it represents the actual suggestion for the trade. These are not AM UK's opinions, and the website in the video is not .co.uk website, but globalnews.com website. Forex is risky business, and this is a personal opinion only, so this webinar is for informational and educational purposes only. Yeah. I see a message. Hi, Tarantula. I made 20 pips today on a index based purely on price action trading, which you presented in earlier versions, in earlier webinars. Great, great. If it works for you, then perfect. I'm very glad to hear that, and really I enjoy all of your success. So thank you for that. Well, you know, we had price action 1, price action 2. Today this is price action 3. So you need to choose which of those price action systems you will trade. But generally, today this system requires at least some basic knowledge on forex market. So it's not so mechanical as you probably like to use. So I will present every time all sorts of methods and systems for those who are novice traders, for those who trade more than a year, 2 years, so you can trade it. So you just need to choose which sort of price action strategy you want. So this is a little bit discretionary method, and I will show you. Some time ago, as I told, this strategy it wasn't free. So you need to know that this wasn't a free strategy, but when I developed Chem MACD, which is a paid strategy, I decided to share this strategy with you. So let's see if we have the sound. I got a message, lost the voice, can't hear anything. If you can hear me, just type yes. I need to see, yeah, sound okay. Thank you. So, NN, right? You should check your microphone, and not microphone. You should check your speakers. Ho, check your speakers. Sound is okay. I received feedback. Yeah, local problems probably. So, what I wanted to say is, this strategy was a paid strategy, and it was developed basically from the work of one, how can I say, a good trader he was. I don't know what happened to him. His name was Hector de Ville, and this method, not particularly this method, I upgraded that method, and I was teaching this method for 2 years before I switched to Camarilla MACD, which is most developed method and my proprietary method. So I will show you this today strategy, but first we need to have a little bit of reminder so you don't forget what is price action, what do we use in price action trading. We will not speak about basic chart and basic candlestick. We will speak with those candlesticks, with those, trend lines and SMAs which comprise this system, not compromise, which comprise the system. And as you know, in this series of webinars, you will go from more simplistic to more complicated strategy. This is more complicated strategy, so pay attention to it. What is price action? Just a little bit of reminder for you. So I'm sure that I need to make sure that you don't forget what is price action. Price action is technical and chart pattern analysis which attempts to find order in sometimes seemingly random movement of price. As you know, we can trade price action, volume spread analysis, harmonic patterns, indicators, combination of price action and indicators, pointed figure, Renko, range bars, which we will talk about next time. You need to sign for Renko range bars system, because I will give you free method, which was also a paid method, and I will give you for free because even scalping I do on Camarilla MACD, so I can share the strategy for free, and that is also range bars scalping method. That will be one of the best scalping methods I have encountered so far, and I have used it extensively before I moved to Camarilla MACD scalping. So I will also share that for free. That will be range bars part 2 webinar. On part 1 webinar, I will talk about range bars and Renko bars, how to set it up on the charts. As you know, MetaTrader 4 has upgraded. MetaTrader has upgraded its MT4 platform, so there has been a lot of hassle with indicators, with placing experts, so I will explain it also. And we will also have a webinar about MT4 platform, this new build, so I will explain how it's used and how you can use it. So let's get back to price action. So swings, high and low, tests of support, resistance, consolidation, and are some examples of price action. Using candlestick patterns, using support resistance levels, trading purely from candles, trend lines, triangles, that is basically what price action is. So when you try price action, you either can trade candlesticks, which comprise basically the price action, but you can also trade price general. So you know, when you trade candlestick, you usually want candlestick to close so you can trade it. When trading price, we actually, I will show you that we actually are trading price. We don't trade candlesticks in this particular method, because the candlestick can go to this price and you want to short it. But when the candlestick closes, let's say that it made a shooting star, you would actually trade it from here, not from here. By trading price action effectively, you will trade this level here, not this candlestick. So trading price has its advantages over trading candlesticks. Effectively, candlestick trading means that you are basically trading candlesticks. So the price can touch the level, then drop if you want to go short, or if you want to go long, it can touch the support, then close above the support at 20 pips. So effectively, you're trading candlesticks, not real price. Real price is picking of the price level, need picking, cherry picking. Carlis, he asked me, it means that we should put pending orders. Sometimes you can put pending orders, but you need to know you know what the problem is with pending orders. As you know, probably from time to time, I also, besides teaching people, I give signals, paid signals and free signals. Free signals you can have on Monday webinars. With paid signals, it's a different story. I need to manage the trade for you. I tell you when to get out, when to put trailing stop, when to exit, how much lots you should trade, and so on. So it's not it's not the paid signals and free signals are a little bit different. Because I need to have time. I also give some signals and I need to manage it. But for free signals, I give you on Mondays, it's completely free. And Aussie Yen from seminar on Monday, just like I said. Dragon, yes, sometimes, well, 70% of the time I can say I'm right. Maybe 30% of the time I'm wrong. I don't know the statistics, but that is how I see it. The problem with pending orders is, you need to know the truth behind those pending orders and market orders. If you want to make pending order effectively, you need to watch the charts. So let's say that I wanted to long into Euro Yen, and I had a pending order today at 140.00. I wanted to have that trade. I wanted to trade it to the upside, and my target would have been 140.80. That was my setup for today. I wanted to trade it, but what happened? The price went to 140.90, and then it went straight up to resistance. And I was thinking, maybe if it goes to 140.50, 60, it will drop to this level so I can trade it. I had a pending order, but I deleted it because next time, if that level 140 is touched, it may break through it and hit my 30-35 pip stop loss. That is the problem with pending orders. With pending orders, you need to trade the very first touch of the price. And for that, you need sometimes, you know what the problem is? If the market is moving very, very fast, and you see that it will touch, so let's say that you want to trade, it doesn't matter, you want to trade whichever pair you want long. So what can happen? It can happen that the price is here, and you wait for that price to come down. Then it may go down, 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 but the momentum is very, very big. So effectively, it can hit your level, go some 5-10 pips, and then drop. So I don't personally like to use pending orders outside the sessions. So if I use pending orders, I prefer it to be during London or during New York session. I just don't want to carry over the trade or place those pending orders during Asia session and during late New York session. You know, that is the problem with pending orders. Also, I need to tell you that I've been extensively using trailing stops. So in next webinar on Monday, I will tell you how to trail the stop if you want to enter on my session recaps. Yeah, so you need to know about it. Yeah, I missed a trade today using pending order by 0.3 pips. Yeah, you know, the problem with pending order is that you effectively it's very, very big problem that if the price doesn't hit your level, it can go 5 pips from your level and then go into your direction. That is why I teach people to use, if your risk is 0.4, you can enter 0.2 at one level, and if it drops to your level, then add 0.2 more. Effectively, that is how I trade, that is how I teach people, that is how I do. And to be honest, last month I made some 6% on accounts using completely other money management, which I used some maybe 1 year or 2 years ago, because those pending orders were rarely hit, and sometimes the price moves 20 pips in my favor and then drops down and hits the stop loss and then goes again into my favor. So that happened from time to time, and that was happening from time to time, and I just stopped that by using trailing stops. So even though sometimes I don't make hundreds of pips in single trade, but effectively 15 to 35, 40 pips can be made with trailing stops. So basically, it's very good, because if you don't trade a single pair, you can make 20, 25, 30 pips, 40 pips per day by trading effectively 5 or 6 pairs, choose from 24 pairs. And that is the beauty of this job. And that is the beauty of full-time trading. That is why I have time to analyze this to you, and why I have free time thanks to also Admiral Markets. So I will be doing that. So let's move on to price action. So candlesticks patterns such as Harami and Gulfing pattern called pin bars are all examples of visually interpreted price action. Again, I need to mention, if you want to trade, let's say this level, you want the price to hit that level and then go in your direction. If you trade candlesticks, the price level can be hit, but the candlestick can close like this. So effectively, you would be trading of this level, not this level. So that is the problem generally with pure candlestick traders. So that is why I prefer price action, full price action. price action is everything that the price does. And just like every other facet of analysis, it's purely subjective. That means that, of course, what it means is it's subjective. My analysis cannot and should not, maybe from time to time, agree with other analysis and also with other analysts. It's because we are all subjective by our nature. We all make presumptions. We all make predictions. We all make an analysis according to, let's say, triangle or price action. My view of the market cannot be the same, and sometimes it's completely different from other analysts' view of the market. So that is basically what price action trader does. He makes predictions based on technical analysis, but he also makes reactions to that price. So that is also the answer to your question about pending orders and market orders. Basically, you want to trade the price, and that means you want to react. If you put pending order, you don't react. It's a sort of prediction. So pending orders effectively are used for good, but I can advise that you need to be close to your trading station when you know that pending order will be hit. Just because of that price action swiftness. So they can be used, but try to be at least close to your PC when it's close to hitting your pending order. Price action usually uses naked chart. Very few indicators or no indicators at all. It's an old school way of trading, which has its roots before modern indicators have been implemented. An increase in price action is another way of saying that volatility has increased. When you see candlesticks like this, big candlesticks, that is also a signal that volatility has increased. Algorithmic trading is not applied to price action trading. So indicators, they follow the price, but using indicators is trading mechanical system. So I always advise novice forex traders to use scalping systems mostly with some forms of indicators. But if you want to switch to full-time trading and professional trading, you will eventually switch from those systems which uses extensive indicators to pure price action. The only indicator which I have on my chart is MACD and of course Camarilla levels. That is support resistance indicator. You can use EMAs, SMAs. They are perfect for dynamic support and resistance. But I really hate to see when chart has more than two indicators, RSI, MACD, CCI on the same chart. For me, in my opinion, that is not serious. That is complete nonsense. I can elaborate on that, but I won't do that now. But I know many traders who use those indicators to trade, and I'm completely against it. You don't have to have 5 different algorithmic indicators on your chart because it will kill your trades, and it will also kill your account. There are a lot of marketeers who will sell those systems for $97 and $297, but they are completely, you know, I would never pay for those kind of things. Now, in price action, we trade trendline breakouts, support resistance levels, Fibonacci and support resistance confluence, breakouts, chart patterns, and candlestick formations. Now, this price action strategy tree will use 1 hour time frame or 4 hour time frame. The difference is, if you want 4 hour time frame, trend needs to be a lot stronger than on 1 hour time frame. You will see why later. So it can be traded on 1 hour time frame or 4 hour time frame. And you need to have a strong trend. This is primarily trend trading method. You cannot take counter trend trades with this, and you cannot take scalps with this method. Breakouts can be traded. I will show you that next time. Divergence can be traded to some extent, not full extent, but primarily trend is traded via this price action strategy. 30, 50, 100 SMA. Fibonacci, trend lines, but just for additional confirmation of confluence. You know that I use confluence in my Camarilla MACD method, and in this method you will see additional confluence. Basically, I have put the best of this method and the other Camarilla floor-based strategies on my Camarilla MACD. But Fibonacci is applied to this method at the very best way. You will see how. And trend lines also. So this is used just for additional confirmation. Then you need whichever daily pivot point indicator you use. But I didn't use Camarilla with this one. Camarilla, I need to say, is completely different method, because it can combine counter trend, divergence, scalping, breakouts, and trend trading in a single template, in a single, just it's completely developed trading method. And this is trend method, but this trend method is very subjective, but it's also very, very good. You will see why. MACD also for trend spotting. You need to have a MACD for trend spotting. Now, let's talk a little bit about trend lines. Trend lines are a visual representation of support and resistance in any given time frame. So you can make trend lines in 1 minute time frame, 5 minute time frame, 30 minute, whatever you want. I personally use trend lines on 1 hour time frame and 4 hour time frame for analysis. Also, taking confluence entries with trend lines and Fibonacci is a very effective way to get into the trade. Trend line is a line that is drawn over swing highs in downtrend or under swing lows in uptrend to show the prevailing direction of the price. Trend line must have at least 2 touches to become valid. The more touches it has, the more valid it is. The more touches the trend line has, the more powerful the move after a trend line break. Long trend lines are more important than short ones. So, if you see a long trend line, but it has 1, 2, or 3 touches, it's great. But if you see a trend line which has 15 touches, 8 touches, 10 touches on a higher time frame, that means that it's very close to be broken to the downside, because there is no trend which lasts forever. Usually there is a deeper retracement prior to going again in the direction of the trend. Shallow trend lines are more reliable than steep trend lines. So shallow trend lines like this or like this are way better than this trend line or this trend line. They are way better because the retracement to this trend line is substantial. So this is basically how you draw a trend line. You need to draw it from point A to point B. So this is point A, this is point B. And when you right click on trend line, you should check ray. That means that the trend line is rayed out into that direction. So when you connect this point with this point, you will see this trend line. If this is left unchecked, your trend line would look like this. So you need to draw it manually. But if you check this, you will see the complete trend line protruding through the price. So you know, when you have 2 touches, the trend line is valid. Well, Tom DeMark said that basically when you had 3 touches, when you have 3 touches of trend line, that means that the trend is captured. I would say yeah, okay, but 2 touches is enough for a trend line. Then the third touch can usually mean maybe a swing. So in this example, let's imagine that there was a swing, another swing, not here, but let's say here. So that would mean 1, 2, 3 touches. So that is first, second, third swing. So I would say stick with 2 touches, it's enough for the trend line to be drawn. So 1, 2 points, connect and rate. Then it will go into your direction. So you can see the reactions here, here, look at this here, look at this here, look at this here, and finally trend line broken there. Market is not perfect, and market movements are not perfect. So when you see 2 touches, which are basically perfect, the third touch cannot be and must not be perfect because it's the market. So sometimes it will be perfect. So let's see, this pin could have extended to here. But you see, this is not the perfect, but yet again, it's a rejection of the trend line. You see where the price ended up. It tested the trend line and rejected. You see here, it also tested the trend line, tried to go down, but rejected. Now, I will give you also some secret now. If you see this, that means that probably the trend will reverse. So, if you trade counter trend with, I don't know, trend lines, you can try to draw this trend line, which has its recent price swings, and wait for breakout, pullback, continuation. So, the first sign that the trend line will be broken is if you see this pin and then rejected above the trend line. Then the price tries to go short, but it stops here and go long. Then yet again the price tried to break to this level, but yet again it was rejected. So this trend line is failing. There is impending danger that the trend line will break. Then you notice other bottoms, such as in this case, and you connect it. 1, 2, 3, 4 touches. Perfect. And then you see breakout, pull back, continuation below this point. So this is also how you want to trade and see breakouts of the trend lines. And particularly, this is how you draw trend line. You need 2 touches for the trend line to be valid. Now, moving averages. Moving averages are time series of data from several consecutive periods. They are called moving because the data in it is constantly recomputed. MAs are mathematical equations used for reducing the effect of temporary variations in data, improving the fit of data to a line, a process called smoothing, to show the data's trend more clearly and highlight any value above or below the trend. They are used widely, and especially I use it, and in this method you will use it as dynamic support and resistance levels. You will use it as dynamic support resistance levels. Classification of MAs. In this method you will see 30, which is blue, 50, which is red, 100, which is green. When SMAs are aligned, we measure the strength of the trend but also dynamic support resistance levels, looking for trend trades around SMAs as retracements. Stop loss usually goes above or below the green SMA. So this means when you see these moving averages aligned like this, that the trend is strong. So you wait for the retracement, as in this case, and then rejection to go short. I will show you that with Fibo also, how you will enter with Fibonacci confluence. Also, you will see, this in this point, there is a switch of the trend from downtrend sideways to uptrend. So for the trend to be confirmed, you need to see green, red, and blue SMAs going clearly to the downside. For uptrend, you need to see SMAs going clearly to the upsides. But the thing is, they all require a strong trend. that means at least couple of days it will be good, because you need, for this method, the trend needs to be strong because you need to capture the trend. In this point, you see the trend has been confirmed. Long entry, long entry, long entry, long entry, long entry. So you need to have a strong trend. If you see that SMAs are showing this price action or this price action or this price action, that is completely invalid. You don't trade that. So you trade only when you see that SMAs are like this or like this. So it's clear. We will move on to the part of the webinar. Also, I will mention it again, where I will mention that again, how you spot the trend. So, but these are the rules also. Pivot points are technical indicators used to determine important support and resistance levels. Is the average of high, low, and closing price for the previous day. It is used to determine market sentiment. They were originally used by floor traders. Those are last session high, low, and close price computed with equations. Usually New York closing time is used 4 in EST or 10 Central European Standard Time. There are a lot of indicators which show pivot point. For this strategy, you need to use daily or weekly pivot points attached to this chart. So you need to use daily or weekly pivot points attached to the chart. Now, Fibonacci, which is maybe, this is indeed the most important part for entries. We use Fibonacci when we want to enter or add to position in trending markets. We don't want to use Fibs when market is ranging. Almer Market's MT forecast Fibonacci tool by default. Now, most important numbers are 38.2, 50, 61.8, 78.6, 88.6. Later, at the end of the webinar, I will show you how to add these numbers, because they are not integrated by default into MT4 Fibonacci, so you need to add them manually. I will show you how to add 78.6 and 88.6. Fibonacci, as you know, is always drawn from the left to the right. Always, always, always. Not the other way. Then you need always to draw it from left to right. Remember that once and for the whole your life. From left to right. Now, rules of this strategy. You need to apply more common sense than price action 1 and price action 2 webinars. This is not a mechanical system. You trade the price here. You don't trade, I don't know, moving average, cross, candlestick patterns, rejections, breakouts of wedges. This is trend trading method, and you trade the trend. So you move on to serious method now, because you need, this is not for everyone. You need to have a proper self-assurance, and you need to demo trade this strategy before you go live. But in trend trading environment, it's very, very good. So also the advantage to other strategies that it works on any trending pair. So you can trade effectively 23, 24 pairs with that. The thing is, you cannot trade counter trend, and you cannot trade wedges, breakouts with this kind of, you can trade it, but this is not the method for trading wedges, breakouts, triangles. And you cannot scalp with that unless you want to take 10, 15 pips out of the market. So I advise using trailing stops. So basically, this is a trend following method. Okay? And you should use it as that. We want to trade 4-hour or 1 hour time frame, but the trend should be strong. I showed you how you can know that the trend is strong. This is the indication that the trend is strong when SMAs are going to the upside. They are not going sideways. They are going upside, and there is a divergence between those SMAs. You can see the space. They are widened. Also, this is a sign for downtrend. They go to the downside. They go to the upside. So you can take breakout trades with this. I will show you that next time, but for now, stick to a trend. So, with that said, we move to non-tradable market conditions. This is when market conditions are not tradable. If you see SMAs like this, you know that market conditions are not tradable. So basically, you will see the intertwining of these SMAs, and when you see that, that means that the market is going sideways. As you can see here, it's going sideways, and you don't trade that pair. So you can move to another pair and trade it. So you can move to another pair and trade it. Once the trend has been confirmed, we wait for the first swing. Ideally, we want the price to pull back to any of 3 SMAs before placing a trade. SMAs need to have a clear direction, as you can see here. This is very important. We don't want the price to proceed above or below green SMA. So, if we see a retracement, we don't want the price to proceed here. We want to see either touch here, or touch here. Eventually, it might go a little bit below this level, but just a tiny bit. Not like this or like this. Ideally, it will come to this point or this point. Or if you want to trade short, it will come here or here. But you want to trade confluence with Fibonacci. Once the retracement starts, draw the Fibo. Fibo always from left to right. We want to see a confluence of Fib, trend line, and SMAs. I advise using trend stop after 15 pips if you use it on 1 hour time frame, or 30 pips if you use it on 4 hour time frame. In this example, I will switch later to real-time chart, but in this example you can see, well, this Fibonacci is drawn from here, okay? So this from left to right, from this point to this point, the top. Now in this point you can see there is a confluence of 50-point Fib and red SMA. For additional confirmation, you can draw a trend line after the price gets closed, but trend lines are only used for additional confirmation, not for primary method. So the confluence of Fibonacci, which is here, and the red SMA, which is here, is used for entering a trade. So you can see the reaction. Same here. You could also draw Fibonacci here and take the entry here. So you can see how trend is perfectly working. But for this kind of methods, you need to have a strong trend. So the big advantage is every single currency pair can be traded. You can see also the rule which needs to be respected is MACD needs to be above 0, or at least blue line need to cross the red line. So in this point you can see that that was the case. MACD was crossed to the upside. You see the blue line above red and histograms above 0, but the most important is that those two lines are basically above the 0. It's not mandatory. It's not mandatory to have MACD aligned like this, because MACD, this method is primarily used for divergence trading, but for additional confirmation of the trend, it's also good. But for primary primary recognition of the trend and confirmation, these three SMAs are used. So you only take trades when there is uptrend like this or there is a downtrend like this. So pay attention. This is your primary trend spotting indicator, SMA. So in this method you can see that the price went, this was the first swing. You see how the price went. This was the first swing basically, and then you can see the reaction. The price went heavily to the upside. This was the second swing, the third swing, the fourth swing, and then it started to go sideways. So basically what happened is this was on 4-hour time frame, very strong trend on euro. So this is very, very good. And it only works in strong trending markets. Euro dollar, you see, ideally they should be aligned like this. Green, red, blue to the downside. Look at those SMAs. You don't want to take these setups. Oh, again, good trade here, long. But this was for short trades. You want to see SMA like this. You can see ideally green, red, and blue. But what happened here is price went to confluence of 23.6 and blue, and it was shorted. The better would be if it happened to come here. So you could have seen a trend line. So you can make you could have made pending order there, ideally. But the price went here, but there is still a confluence. How I would enter the trade? If my risk is 0.5, I would enter here 0.25, and I would add here, if the price went here, I would add 0.25. So always, your risk is always based to your stop loss. So you need to count the stop loss and base your risk to your stop loss. Also, you can see here how the price went basically to short trade. So this was the first swing. You can see red, green, red, and blue. This could have been, and this is the first swing. But you can see also the second swing here. You see confluence of Fibonacci, trend line, and red SMA. You can see here again. And look at MACD, it was below zero. Additional confirmation of the trend. Now, this strategy can also exploit breakouts and divergence. We will talk about it next time, and this is effective strategy, but it requires knowledge in Forex market. Now, we will move on to, I will show you now how you can add 78.6 and 88.6. So insert Fibonacci. Let's say that you want to use Fibonacci from this point to this point. Now, click on Objects List, click on Fibonacci, and now you see I will delete, and I will delete here. So this is how you will see default Fibonacci levels. Without this, let's clear it also. So insert Fibonacci retracement from the left to the right, like this. Now again it showed, I don't know why I deleted it, but doesn't matter. You see it. Let me clear it again. Okay, close. Oh, now it's okay. So by default you will see Fibonacci like this. So from left to right, again from left to right, swings from below to the top, because this was the first swing. After this swing, the retracement has started. How you can define the retracement? How you know that the retracement has started? Because after this candle, the next candle was going to the downside. If this candle made a new high, that wouldn't be a start of retracement. So the first candle which goes in the other direction of the last candle, that will be a sign for retracement. So this was the high, and this candle made a lower low. So this candle was a signal that retracement has started. After this candle, you need to draw Fibonacci from left to right. And you see here. Now, you need to add 78.6 and 88.6 for a deep retracement. Put Fibo here and add. You need to type 0.786 and description 78.6. Then you need to add 0.886, description 88.6. Okay? When you did that, your levels will be plotted on the chart. You can see it here. Okay? In this point, we have also blue and red confluence. So this level is good, this zone is good for long trades. You see? Ideally, you cannot use pivot points if you don't want. Because if you see a swing, you presume that the next target will be just a little bit below this high. So if you have traded a price here, I would go for this level, and if I see that it's been breaking through, once it's broken through, I would place trailing stop here. So stop loss, I would move my stop loss here and wait for other levels. So when the price has indeed moved to other level, we mark it like this. Okay, we mark it like this, and we wait for the retracement. Now we need to remove Fibonacci, and let's remove, well, we don't need to, but just for the sake of this presentation. So this was the level, this was the high. Okay, now the price started to retrace here. As I said, we want a confluence of SMAs and Fibonacci. Then we drove again from last swing low to the last swing high. And you can see the confluence comes, I cannot say it's here, it doesn't touch red level, but this 61.8 touches red perfectly. And we can also make a trend line once this candle has been closed for additional confirmation. Okay, so let's say that you have spotted a confluence here. So you entered here, it's only a couple of pip difference. So this is a confluence, red and 61.8. You enter here, the candle has closed, a little bit of drawdown. You can see how it reacted to a trend line confluence with red, SMA and 61.8. Again, my target would be here, but I would trail the stop once it breaks. Now the next swing is there, and the next swing is there. So effectively you don't need to use pivot points if you trail the stop. You can mark those levels by your hand. It's very easy, I showed you now. Now, this is a strong trend on 4-hour time frame. It won't happen very, very often, but once it happens, it's great. So let's see where would we take here entry. So the next entry could have been, let's say, Fibonacci. This was the swing low, this was the swing high. Then swing low, great. Swing low, swing high. Here. Swing low, swing high. Where is the confluence? I didn't draw Fibonacci correctly because I need to have it space. Need to have the space to show me where is the confluence. So I need to drive it like here, like this. Okay, like this. So where is the confluence? It's easy to see here, 50, because 50 line is intersecting this red SMA. So this is the confluence. Once this retracement starts from here, it didn't make a new high. You see, this is retracement. You immediately after this candle you make Fibonacci, and then you see where is the confluence. The first confluence is here, and it's okay. The first confluence is here, 38.2 and blue. It was good for 30 pips. Great. Trailing stop, 30 pips. 25, 30 pips on 4-hour time frame. So this was very good trade. Then it drops again to second confluence here. Why confluence? Because red is intersecting with 50. So basically this is it. This is the confluence. You see the reaction. There is a trend line, historical trend line. But you can also place another trend line here. You can also place another trend line here once the price touches it. So this is double confirmation. You are, how can I say, your mind is peaceful when you see that there is a good confirmation for long trades. So you see the price has been rejected from this confluence point and it went 80 pips to the downside. Multiple rejections. You see how many pips you could have made. And here you don't trade this. You're staying out of euro dollar and you can move to GBPUSD maybe. Let's move to GBPUSD. This is a first swing. Okay, we need to be patient with this method. The first swing, swing low and swing high, okay? Now, where is the confluence? The confluence, here is another swing high, so we need to redraw it, okay? Insert, Fibonacci retracement. Swing low, swing high, okay? Here is the swing high. First confluence is here, 23.6 and blue. Second confluence comes here, and you see, it was very, very close. So that is why I call it discretionary. It's very close, couple of pips. But this was also the zone. Only 10 pips so far, zone. You see here, and if you traded it here at this point, you would have 18 pips initially, 30 pips drawdown, and 70 pips later. But in this point, red, let's see, you trade it from here, you would have almost 100 pips to the upside. Also the trend line shows you, you see, another confirmation of the confluence. So you can even enter here with a lesser leverage, and you see you can drive it there. Now there are two methods for placing stop loss. Aggressive method is placing the stop loss below this point. And I usually did that. I usually did that because, you know, when you take it, when you take a trade from here, usually when there is a strong trend, you can place stop loss just below the confluence. So this is the confluence. Trend line, red SMA, and 38.2. Where would I place logically? 5-10 pips below this level. So below 38.2, I would place my stop loss. That is aggressive placement. Then there is a dead stop or conservative placement below this level. But usually when price breaks heavily, it will hit your stop loss and it will, as you can see here, it will switch directions. So then what you can do, you need to trade short from here. There is no guesswork, guys. Look, swing high, swing, let's see this swing. Swing low here. The first confluence here. It isn't perfect, but it's still a confluence. You can put a trend line here. Down. Then, let's clear this. Now, second swing. Insert Fibonacci. You just go from swing to swing. This was the second swing, and here we go. Look at this perfect confluence. There it was the first confluence, blue and 61.8. And if you traded it, maximum 55 pips. Then it goes to the upside. Second confluence, perfect confluence. $400 pips, 148 pips in a single swing. Trend line. Can we draw a trend line? Of course we can. Look at this. Another swing, another swing. Look how it perfectly followed the trend line here at the next swing. Then we needed to move this trend line here. Another confluence point, red, blue, and 38.2 to the downside. So you don't need a MACD for this, because you see that the trend is clear. But MACD, primarily I use it for spotting divergence. So now I have showed you how to use it. So guys, we have come to the end of our webinar. You can see if you want to ask me something, now is the time to ask me. This webinar will be uploaded. So you can check it again, and if you like it, you can of course trade it. It's not, as you can see, you will get a hang of it once you go through this webinar a couple of times. Look at this. It's very good in trending markets. Look at this. Swing high, swing low. Look at this. Confluence here, drop. Confluence here, drop. That is why I use trailing stop. Initially, most of these trades, 80% of the time, will go in profit. But you need to use trailing stop because you don't know whether the retracement will be deeper. Here, 30 points. From this point, 39 points. Potential. This point here, confluence, 175 pip potential, okay? And now the trend is changing. Break, look at this. This is a sign of a trend change or a trend continuation. You don't trade sideways price action. This was the start of the trend. This, let's see whether we could have made money here. Swing high, swing low to the upside. Yeah, we could have made some money here. This was basically where the price went 6-7 pips and then dropped, and in this particular point it made 25 pips and drop. That is why you use trailing stop, and this was the trend change. This was again a very strong trend. See here, one swing, second swing. You need to find confluence for your entries. There you don't trade this. One swing, second swing. Here can be also traded. Let's see. Confluence points. Here, this zone has a confluence. Perfect confluence. It doesn't exist. But you can see here at this particular zone, selling opportunities, 90 pip differential. Okay? So you can go through this, all of these charts, picking the trades and learning this particular method. So this will be enough for today. Next time when we will talk about price action trading 4, be sure to sign in because I will show you how to use divergence here and how to make breakouts. Okay? For trend trades, this is enough. Look at this. I didn't cherry pick this pair. I just draw it to the... Look at this. All of the trends could be exploited here. Almost all of the trends. Look at this. Confluence. Confluence. Because when you have a strong trend, this method excels. Look. GBPUSD. Okay guys, so if you don't have any questions, we can clear this webinar. Be sure to sign up for, of course, new webinars, and each week we will have a session recaps. Each day I make free analysis to you. Also, as you can see, my thread here, you can see here, you can see also Admiral Markets. So basically, sign up for webinars. Let me pause the screen for a moment and I will show you the blog. You know where the blog is. Here is the blog. daily analysis for different pairs: Euro dollar, Aussie CAD, Aussie dollar, Swissy, GBP, Aussie Swissy, New Zealand yen, and of course webinars. So you can sign in and use that knowledge because it's free. Price action trading 3 today webinar, weekly forex recap, discretionary trading. This is discretionary trading, this method I'm using, and I will tell you why I prefer discretionary trading. That's my favorite. Camarilla MACD is discretionary trading, and I like it. This Renko range bars, part 1 also. So sign in for this and enjoy free pips. So thank you guys for attending. I think this was very clear to you, and if you are not so clear with this method, this webinar will be uploaded. So I will also, if someone needs those indicators, this is my email, not for this method but for past methods, tarantulalafx@gmail.com. So you can ask me for indicators. I'll be sending to you. If this system is a little bit hard to you, then go through this webinar again a couple of times and you will see the power of it. So thank you guys for comments. Thank you very much for listening to me, and talk to you very, very soon. Cheers.